Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of DaVita Inc., ticker symbol DVA. We're looking at DaVita today because their stock price is starting to rebound from their 52-week low, and Berkshire Hathaway owns a significant position in DaVita. So flipping here to the Berkshire Hathaway public stock portfolio, DaVita is the 12th largest position that's reported on in the 13F filings that Berkshire has to disclose. Even coming in at number 12, they only make up 1% of the portfolio with a market cap of about $4 billion as of the first quarter of this year. What makes DaVita interesting is that Berkshire owns 38% of the business. So of their public stocks, Berkshire actually has the highest ownership in DaVita, above some of the businesses that Berkshire has big ownership stakes in that get some of the limelight, such as their expensive acquisition of Kraft Heinz Corporation, and then more recently, the big buildup in their Occidental Petroleum position. So the fact that Berkshire owns nearly 40% of this business alone makes it an anomaly, especially because it's a publicly traded company still. So DaVita could potentially be an acquisition target for Berkshire to purchase the remaining 62% of the business one day. However, that's just speculation. If you're unfamiliar with how Berkshire's public stock portfolio is managed, they have 3 investment managers, famously Warren Buffett. Then they also have 2 other investment managers, Ted Wexler and Todd Combs, who collectively run about $20 to $30 billion of the portfolio. That number was disclosed a couple of years ago, so it might be a larger percentage now as their market positions have grown. However, we do have some background on DaVita. DaVita is a position from Ted Wexler. It was a long-time position in his Peninsula Fund portfolio. Peninsula was the hedge fund that Ted Wexler ran before becoming a Berkshire investment manager. So at the time of recording this video, DaVita is trading for $86.17 per share. Year to date, their stock price is down 24%. They hit their low recently back at the end of June and have been steadily increasing from there. Year to date, their stock price is down 27%. Over the past 5 years, however, they're up 5.5% compounded annually. Over 10 years, that number is pretty consistent. And going back 17.5 years prior to the global financial crisis, DaVita's stock price has returned about 8.5% compounded annually. So DaVita is trading about $11 over their 52-week low, which is down by about 40% from their 52-week high. DaVita is an $8 billion market cap. So for some background about the business, DaVita is the largest provider of dialysis services in the United States, boasting market share that eclipses 35% when measured by both patients and clinics. The firm operates over 3,100 facilities worldwide, mostly in the United States, and it treats over 240,000 patients globally each year. Government payers dominate U.S. dialysis reimbursement, and DaVita receives approximately 69% of U.S. sales at government, primarily Medicare reimbursement rates, with the remaining 31% coming from commercial insurers. While commercial or private insurance represents only about 10% of the U.S. patients treated, they make up nearly all of the profits generated by DaVita in the U.S. dialysis business. As of the end of last year, DaVita provided dialysis and administrative services in the United States through a network of 2,815 outpatient dialysis centers, serving over 200,000 patients. It operated 339 outpatient dialysis centers in 10 countries outside of the United States, serving another 40,000 patients. Farther, DaVita provides acute inpatient dialysis services in approximately 850 hospitals and related laboratory services in the United States. DaVita Inc. was incorporated in 1994 and is headquartered in Denver, Colorado. For our fundamental analysis today, we're going to be performing a modified version of the 8-pillar analysis popularized by Everything Money, taking a look at 8 key financial metrics of DaVita and coming to an overall beginning and holistic understanding of DaVita based on those fundamentals. So let's get right into our analysis. Starting off with pillar number 1, we want DaVita's average PE over the past 5 years to be below 22.5. Currently, DaVita is trading at 10 times earnings. Over this period, they've gotten down to as low as 8 times earnings and as high as 30 times earnings. However, averaged out, they've traded at about 16 times earnings. So this is going to be a check to start off on pillar number 1. Pillar number 2, we want their average 5-year return on capital to be above 9%. Over the course of decades, over the long run, a stock is going to return approximately what its underlying business returns, and those business returns are going to be captured here by return on capital. So DaVita earns a very steady return on capital. Over this time frame, they're averaging out at earning about 11% per year. The lowest they've gotten to was about a 9.5% return on capital. So in an industry that has ties to government-regulated healthcare like this, it's good to see that DaVita is earning above average returns on capital, but they're pretty stable and they're somewhat regulated. So that's another check here on pillar number 2. Pillar number 3, we're looking for 5-year revenue growth. DaVita has grown revenues from $10.8 billion in 2017 up to $11.6 billion in 2021. So that's a check here on pillar number 3, and that's our third check in a row. Pillar number 4, we're looking for 5-year net income growth. DaVita's also grown net incomes from $663 million in 2017 up to $978 million in 2021. So far through 4 pillars, we've got 4 checks. Pillar number 5, we're looking for decreasing shares outstanding. This is where DaVita really shines. When you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a business buys back stock by repurchasing shares, they're decreasing the number of shares outstanding, which ultimately increases your ownership percentage in that business and increases the percentage of that business's profits that you're going to be entitled to. So they do all that without you having to spend a dime. So we want businesses that are buying back shares at reasonable valuations, ultimately creating value for existing shareholders. DaVita has done just this. Over this time frame, they've reduced their shares outstanding from 191 million in 2017 down to about 110 million in 2021. The effect of this is that DaVita has bought back 43% of their shares outstanding, and this is absolutely gold for long-term buy and hold investors of DaVita. They've been buying back shares for over the past 20 years here, and they've completely cannibalized their share count outstanding, bringing it down quite significantly over that time. It's because of their large share buybacks that Berkshire's position is so huge in the company at 38%. Their share buybacks have been the case for the past 20 years. Hopefully this is something that'll continue to happen into the future, especially as they're currently trading at what seems to be depressed valuations. So that's a check here on pillar number 5. Again, through 5 pillars, we have 5 checks. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's the lifeblood of any business, and a business's ability to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. Free cash flow can be used to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the business. So over this time frame, DaVita has grown their free cash flows from just over $1 billion in 2017 to about $1.3 billion in 2021. That's another check here on pillar number 6, 6 in a row so far. And in an average year, DaVita is producing about $1.2 billion of free cash flow. We're going to be using this number coming up in pillars 7 and 8. Next up, pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. So at the end of last year, DaVita had about $11.5 billion of net debt. When we multiply their average 5-year free cash flow of $1.2 billion, this only brings us to $6 billion. So this is going to be our first X here all the way along in pillar number 7. Ultimately, we're using this pillar to evaluate how the business is utilizing leverage. We don't want to be investing in highly levered businesses that aren't able to support their debt loads. DaVita does operate in a pretty heavily regulated space, so these types of debt loads could be appropriate given the fact that the business has pretty stable and consistent free cash flow yields, as well as producing that pretty stable above average return on capital. However, this is something that you're going to just want to learn more about. Overall, relative to their free cash flows, they have quite a bit of debt. So to dig deeper into this business, you really want to understand how this debt is structured and when it matures. Again, this is our first X here on pillar number 7. Finally, the big pillar of them all, pillar number 8, We want their market cap to be below their average 5-year free cash flow multiplied by 20 to give us a starting point as to a reasonable valuation for the business. So currently, DaVita has a market cap of about $8.1 billion. When we multiply their average 5-year free cash flow of $1.2 billion times 20, that brings us all the way to $24 billion. So we have about $16 billion margin of safety here. That is a massive check. However, this market cap isn't going to be totally reflective of that underlying economic reality. A more appropriate measure would be comparing it to their total enterprise value. So total enterprise value is going to be their market cap plus their net debt. Here, even at $21 billion of total enterprise value, we're still left with a $3 billion margin of safety based on their free cash flows. So this is still a check here. Based on their free cash flows, it looks like there's a decent amount of margin of safety in their current stock price. So finally, let's walk through Ted Wexler's investment thesis in DaVita. He wrote this up in his final Peninsula Investors letter. This was written back in 2011, but a lot of this still holds true. DaVita benefits from several positive attributes. They have an outstanding management team. They provide a very efficient delivery model. The business provides a life-sustaining therapy. DaVita's patient customers cannot live without the therapy the company provides, which creates a very stable and recession-resistant business model. They have about 4 to 5% average annual increases in patient count. They also have a pricing umbrella because there are a lot of smaller, less efficient providers that they compete with. Many of these smaller dialysis providers operate at or near break-even costs. So if there were to be any major reductions in reimbursement by the federal government or from private insurers, that could have the effect of killing off a lot of these smaller providers, which is something that the US government would really not want to have happen, as they want this market to stay competitive. And so that looks like that's going to be a very unlikely policy outcome. Then DaVita also has thoughtful and active capital management. As we've seen, they've significantly decreased their shares outstanding, and they've been doing that for the past 20 years. And then DaVita also has significant growth opportunities through both their international expansion, which they started in 2011, as well as continuing to provide a higher percentage of the healthcare needs of its patient base. So DaVita has a lot of strong factors working in its favor. It's a favored business that continues to grow in these single digits. It's performed massive buybacks, and it earns above average returns on capitals. Overall, it checks the box on 7 out of our 8 pillars. And to learn more about the business and be comfortable investing in DaVita, you really need to understand how their debt is structured, because they've got a lot of it. Although based on their abilities to produce free cash flows, it looks like there's a margin of safety in this business, even when including that high debt load. This type of analysis is not financial advice. This is a beginning and holistic look at DaVita as a business. It's not a buy or sell recommendation. If you're interested in learning more about DaVita, I highly recommend diving into the business's 10K. You'll get an even better understanding of the business. You'll get a feel for management, and then it's also going to help you understand the business's risks. That's something that I'm personally interested in doing. And so with that said, that's it for today's fundamental stock analysis of DaVita Inc., ticker symbol DVA. Berkshire Hathaway owns 38% of this business, and DaVita is the 12th largest U.S. position in the Berkshire Hathaway public stock portfolio. So if you enjoyed today's video about DaVita, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about DaVita with me, and have a great day.